Hey, what's up, everybody? This is Steve with the Malone Realty Group over at EXP, and I am joined today by one of my good friends, Miss Sandy Hill with Fairway Independent Mortgage. Let me pull up Miss Sandy. Did I already messed this up? No, there she is. Miss Sandy, how you doing this morning, or this afternoon, I should say?
I am doing fabulous, Steve. How are you?
I'm doing good, doing good. I wanted to have you on. I want to ask a couple questions because we're in a networking group together, and you said something yesterday that kind of got the wheels turning in my brain, which doesn't happen often. But anyway, so the first thing I wanted to talk about was the kind of where the rates are right now and where they've been this year. Because from where I sit, kind of following it, looks like they've kind of gone up and down, up and down, up and down, with a steady trend of just slightly up. Is that kind of how the rates have gone this year?
Absolutely, Steve. So we have seen from our very low in the last 6 to 12 months, we are probably about 0.5% to 3/4 from the lowest low. The good news is we are just still creeping up slowly. We're still in historic low interest rates. It's still an awesome time to buy, but we are seeing that the market is driving rates up a bit, not quickly, but by 1/8%. I would say typically 1/8%, maybe every 4 to 5 weeks, depending on the current economic factors that come into play. So great rates.
Absolutely, absolutely. So of course the $1 million question, and obviously nobody knows the exact answer, but I mean, what's going to happen? As you look into your crystal ball, you've done this for a long time. Obviously, I don't know what Q4 is going to look like, but what's 2022 going to look like? What are your thoughts on what the rates are going to do?
So what I'm seeing and reading in the forecast, they just say nobody has that perfect crystal ball, but we are seeing that the economic indicators and the flow of the charts that we always follow with the Dow, with the 10-year Treasury, we're basically seeing that upward curve. And when I say that, most of those people are saying probably will be anywhere from 0.5%, maybe 3/4% greater in Q1, Q2 of 22. So over the next 2-3 months, we may see a quarter upward motion. Maybe in the next 2 to 3 months, another quarter. So where we land this time next summer would be somewhere in the mid to low fours. So nobody has that etched in stone, but it's a good time. That's why the time is now to go ahead and get your maximum buying power.
Right, because I mean, we were talking about, what does that mean? Like, let's say it goes up 0.75%. If you're buying a $350,000 house at 0.75%, like, what does that equate to like in a monthly mortgage?
So roughly, I would say that difference could be as little as, depending on how you look at it, as little as $100 a month. It's not a huge factor, but certainly as the loan amount starts creeping up, that number gets bigger.
I mean, $100 to $150 a month. I mean, you're talking about $1,000 to maybe close to $2,000 a year, and so on and so forth. I mean, that's decent buying power. Number one. Number two, if you're willing to pay that, that's money that you could put towards a slightly higher house right now. You know what I mean? So there's that too. The other big news you were talking about yesterday was the limit on the conforming loans. So talk about kind of what that means, what that limit's gone to. What does that mean if you're looking to buy a house in that price range?
Oh, fabulous news. This has, it was announced by the Federal Housing Authority that annually they establish what the conforming loan limit is. And that's basically based on data for what the average median house price has been across the country. I mean, during this crazy market this last year, we saw house prices go up pretty significantly, right? So that average conforming loan amount for 21 was 500, as far as loan amount, max loan amount was $548,250. it has been announced that for 2022, that number is going up to 625,000. So about 75,000 difference here in loan amount, so that someone can have a conforming rate, which means a much lower rate than if they got into a jumbo product.
Right.
So an easier process, much easier underwriting, and allow somebody at a purchase price of as much as 644 to put 3% down and still get a conforming loan limit at 625. Awesome. Really good news.
Yeah, because you can't do that little bit of loan down for a jumbo.
So minimum 10, usually 20% down for a jumbo. So it definitely widens the buying power for some of our buyers and clients, especially with the escalating values. They're going to have a little bit more buying power as well, and still be able to be in that conforming loan limit.
Which is cool because, you know, with people that are in that limit or in that kind of right on the edge, now they have, you know, a few more, you know, options, you know, going forward than they've had, because this market's been crazy for buyers, without a doubt. Okay, cool. All right, so one last bonus question for Sandy Hill, because we've been talking a lot lately and sending you a lot of people who are just kind of getting the ball rolling, wanting to get, you know, they want to get pre-approved, they want to get a loan. What's the one thing, you know, as they look forward, they say, all right, in 12 months, 6 months, 12 months, I want to buy a house. As they look forward and they really haven't gotten the ball, quote, rolling, what's the one thing that they can do to that, or what's the one thing that they're doing that they don't realize they're doing that's wrong? Or what's the one thing they should be doing? Like, is there something that people can be, you know, before they get that ball rolling, what's the one thing that buyers should be thinking to themselves credit-wise going forward?
Great question. So I can tell you the number one thing is folks need to have that conversation with me. We need to get their credit in hand so that we can get a strategy as to what may or may not need to be paid off, versus then going ahead and zeroing out a credit card, paying off a car, which could actually drive their credit score down. You have to have credit. You have to show that consistent pay history for your credit score to continue to stabilize or to go up. So my biggest advice is go ahead, let's get your credit, let's have a strategy. Basically, the rule of thumb is that you want to keep your consumer debt less than 40% of the high credit. The lower we get beyond that, the better it's going to raise your credit score. But one fallacy is some folks think, let me go ahead and pay off everything before I talk to the lender. Then they have no active activity on their credit report, and their scores actually go down. And that's really sad, because they thought they were doing something great that would help them, and actually it would have been better to have that money in the bank and let us strategically plan for what we do with those credit cards.
Right, and which is, as we've talked about that a lot in the past, and it's really weird because you think to yourself, we all have that Dave Ramsey in us. Let's pay it all off. Let's be debt free, and which, I mean, we want to do, but there has to be a strategic way of doing it. There has to be a strategic way. Because I've worked with people who they paid everything off and then they closed the credit cards, and it's like, oh, yeah, because you need that record.
When you close the credit line,
right,
it essentially will drop your score anywhere from 40 to 60 points. So absolutely closing credit cards is not a good thing when you're going through the process.
There you go. All right. So if you're thinking about doing it in the next 6 to 12 months, hold on. Before you do all that, talk to a professional like Sandy Hill and let come up with a game plan of this is how we're gonna get into it, because there's going to be 6 to 12 months. This is a great time to plan for it, That's something we always tell people is like, oh, they say, oh, we're not doing anything for 6 to 12 months. Wonderful. Let's talk about it. Let's start making the plan now, because that's just going to make things so much easier, so much smoother, make you a better buyer, a stronger buyer, and you're going to like the whole process a lot more if we start planning now. I mean, and that means not only talking about the house side of it, but also talking about the loan side of it too with Miss Sandy Hill, right?
Absolutely. Happy to help. Happy to get that strategy in place.
Very good. Very good. All right. That was Miss Sandy Hill with Fairway Mortgage. She is my preferred lender. She takes awesome care of all my people, takes awesome care of me. So if you need an introduction to her, reach out to me, 470-233-4409. This is Steve, Malone Realty Group. Take care. Y'all have a good day. Bye.